If you ever looked at a company's earnings report and felt maybe a bit lost in the numbers and all the jargon, wishing someone could just kind of distill it down to what really matters.
Yeah, cut through the noise.
Exactly. Well, you're in the right place. Welcome to the Deep Dive.
Today, we're taking that deep dive into KeyCorp's second quarter 2025 earnings conference call and the financial release that goes with it.
Right. These results just came out today, July 22, 2025.
That's right. Fresh off the press.
So our mission here is really to extract the most important nuggets of knowledge, the key insights from all this material.
Yeah. We want to understand KeyCorp's financial health, obviously.
And their strategic moves, in what their CEO, Chris Gorman, called a dynamic and complex macro environment right at the start of the call.
Dynamic and complex. That sounds about right for these days.
It does. And ultimately, what their performance might tell us about the broader economy, it's about getting to the core of what's truly significant for you, the listener.
And I think this particular deep dive, it offers a really fascinating snapshot. It shows how a major financial player isn't just, surviving this complexity,
Right.
but actually kind of leveraging it, thriving even. So let's dig into the numbers that paint that picture.
Okay, let's do that. Let's unpack this with some key figures right away. KeyCorp reported strong Q2 results. What were the standout numbers, the ones that immediately grabbed your attention? What's the big story?
Well, her headline, I think, has to be the net income attributable to common shareholders came in at $387 million.
Okay.
Which translates to earnings per share of $0.35.
35 cents. And how does that compare?
Well, that's the interesting part. It's up from $0.33 per share just last quarter, Q1 25.
Okay, sequential growth.
Right. And it's a really substantial jump from $0.25 in Q2 of last year, 2024.
So year over year, that's quite significant.
Exactly. It's not just growth. It feels like accelerating growth.
That's a powerful acceleration then. So what's really driving that kind of performance? What's under the hood?
It's largely fueled by some pretty impressive revenue growth, up a remarkable 21% year over year.
21%. Wow.
Yeah, hitting $1.8 billion on a taxable equivalent basis. But here's the key insight, I think. This revenue growth far outpaced their expense growth. Expenses were up only about 7% year over year.
Okay.
Or even just 6% if you back out a pre-funded charitable contribution they made.
Got it. So revenue growing much faster than costs.
Precisely. And that indicates what we call significant positive operating leverage.
Positive operating leverage. Okay, that's definitely a phrase we love to hear. For our listeners, what does that actually mean in practical terms for a bank like KeyCorp?
Right. It basically means that each new dollar of revenue they bring in is disproportionately more profitable. Their costs aren't growing nearly as fast as their income.
So better margins on growth.
Exactly. For a bank, it suggests, real efficiency and scalability. They're turning these broader market dynamics into, a powerful profit engine for themselves.
That's a crucial distinction. Makes sense. Okay, what about their core banking metrics? Things like net interest income, net interest margin. How are those looking?
Also very strong. Net interest income, or NII, that was up 4% sequentially from Q1.
Okay.
And a whopping 28% year over year, reached $1.15 billion.
28% NII growth year over year. That's huge.
It is. And their net interest margin, the NIM, also saw a healthy increase, up 8 basis points sequentially to 2.66% and 62 basis points year over year. But what's really fascinating here, I think, is that this NII growth marks their 5th straight quarter of increase.
5 quarters in a row, okay.
Yeah, and their pre-provision net revenue, PPNR, that's basically revenue minus expenses before you account for loan losses.
Right, a core profitability measure.
Exactly. That's grown over 60% since the first quarter of 2024. It just shows their core operations are consistently improving.
So definitely not just a one-off strong quarter. It's a clear trend, which leads me to ask, how is their credit quality holding up in this, complex environment we keep talking about, especially with all the chatter about potential economic shifts?
Yeah, good question. And their credit metrics are, frankly, remarkably positive.
Really?
Yeah. Net charge-offs actually declined 7% from Q1, came in at $102 million,
Okay.
which is just 0.39% of average loans. That's a very low number historically.
Uh,
And things like criticized loans and delinquencies, they also saw declines. Non-performing assets were basically stable.
Stable's good there.
Very good. And
Yeah.
get this marks the 6th consecutive quarter of overall credit migration improvement.
6th.
Wow. And commercial upgrades, meaning loans getting healthier ratings, actually exceeded downgrades this past quarter.
Okay, 6 consecutive quarters of credit improvement in this economic climate. That's not just positive. That sounds, well, quite remarkable.
It really is.
What specific strategies or maybe shifts in their loan book do you think are contributing to that? How are they pulling that off?
Well, it certainly speaks to a very disciplined approach, underwriting risk management,
Mm.
but also, I think, to the health of their underlying client base, which maybe we can talk about more later.
Yeah, definitely.
It's not just about avoiding bad loans, right? It seems like they're actively upgrading the quality of their existing portfolio, engaging with clients.
Right, proactive management. So given all this strong earnings, positive leverage, improving credit, what does this mean for KeyCorp's overall health, their ability to withstand bumps in the road?
It points to a very strong capital position, their Common Equity Tier 1 ratio, CET1.
The key capital measure.
Exactly. It was 11.7%. Now, for listeners, CET1 is that crucial measure of a bank's financial strength, its core capital buffer.
And 11.7% is.
KeyCorp believes this ratio is at or near the top of their peer group.
Okay, so very well capitalized.
Very. It indicates they have a substantial cushion against potential economic shocks and also, importantly, ample capacity for growth.
Okay, building on those impressive headline numbers. Let's pivot a bit. Let's talk about the real pulse of a bank's health, growing loans and attracting deposits.
Yeah.
What did our deep dive reveal there?
Yeah, absolutely crucial. On the loan side, average loans were up $1.4 billion sequentially.
Okay.
And period-end loans, the snapshot at the end of June, increased by $1.6 billion.
Solid growth.
Solid growth. But what's particularly impressive, I thought, was commercial loans specifically. They grew by $3.3 billion.
$3.3 billion.
Yeah, or 5% just in the first half of the year to date.
Okay.
Which means, and they highlighted this, they've already achieved their full-year plan for commercial loan growth.
Wait, achieved their full year plan by the end of June?
Exactly, by the end of Q2.
That is certainly impressive. But, I mean, does reaching it so early maybe suggest they set kind of conservative targets to begin with? Or are there some unexpected tailwinds pushing this?
That's a fair question. Their commentary suggests it's more about really capitalizing on the opportunities they're seeing right now.
Okay.
They describe the growth as broad-based across industries and regions. It includes both large institutions and middle-market clients.
So not concentrated in one area.
Not concentrated. And what's maybe even more noteworthy is they said most of this growth came from new clients.
So they're winning business, market share gains.
Seems like it. Strong market penetration, successful acquisition efforts. We also saw commercial and industrial C&I line utilization tick up a bit, about 50 basis points to 32%.
Meaning existing clients are drawing a bit more of their credit lines too.
Right. So activity from both new and existing clients.
Got it. Okay. Beyond loans, deposits, the other side of the balance sheet, the lifeblood. How has KeyCorp managed its deposit franchise? It's a competitive world out there for deposits.
It certainly is. They emphasize what they call their high-quality deposit franchise. And they pointed out they entered the year with a, quote, historically low loan-to-deposit ratio of 70%.
70%. So lots of deposits relative to loans.
Exactly. Think of it like having a lot more deposits on hand than they'd actually lent out. That gave them significant financial, well, wiggle room. Flexibility to do work.
Flexibility to, as they put it, prioritize beta management.
Okay. Beta management, that's one of those banking terms that sounds important but can be a bit abstract. Can you break down what that actually means for listeners? Why is it so key right now?
Sure. So think of beta as basically how sensitive the interest rates a bank pays on its deposits are to changes in broader market rates, like the Fed funds rate.
Okay.
When market rates were shooting up, banks had to raise their deposit rates to keep and attract funds, right?
Mm-hmm.
Beta management means they actively controlled how much they passed on those rate increases to their depositors. Try not to raise them too fast or too high.
Got it. Managing the cost of funds.
Exactly. And now, as rates have maybe stabilized or are expected to potentially come down later,
they're managing down their deposit costs. They said those costs are now below 2%.
Below 2%. That sounds pretty good in this environment.
It is. And what's particularly interesting is they talked about their cumulative down beta.
Down beta.
Yeah, meaning how much they've reduced deposit rates since market rates peaked. They said that down beta has now caught up to their terminal beta, the peak rate sensitivity from the last rising rate cycle.
Whoa, okay. In simpler terms.
In simpler terms, it suggests they've effectively squeezed out pretty much all the benefit they could from that specific rate environment on the deposit cost side. Shows really astute management of their funding.
That flexibility and that really smart management of funding costs sounds absolutely key. Okay, now let's talk about the other side of revenue, the fee-based businesses.
Yeah.
Often a sign of diversification, right?
Right.
And underlying strength beyond just lending.
Absolutely. And that was another strong area. Non-interest income, which covers all those fee businesses, grew a strong 10% year over year.
10% growth in fees is solid.
It's very solid. Investment banking, for instance, had its second best first half of the year in history.
Best ever. Wow.
Yeah, they raised over $30 billion of capital for clients just in Q2. Commercial payments, their fee equivalent revenue there grew high single digits year over year.
Okay.
Assets under management, AUM, hit a record $64 billion.
Record AUM.
Record AUM. And sales production in their mass affluent segment serving wealthier individuals was also a record in the first half of the year. Plus, commercial mortgage servicing continued its strong performance.
It's a really broad-based strength in fees, too.
Very broad-based. It shows that diversified income stream makes them less reliant solely on, what interest rates are doing day to day.
Right, that diversification buffer. With this level of success, it suggests a really solid foundation, smart diversification. But are they resting on their laurels, or are they actively investing to keep this momentum going, investing for future growth?
Oh, they are definitely investing for the long term. They made that pretty clear. They're on track to increase their frontline bankers and client advisors by roughly 10% this year.
10% increase in frontline staff. That's significant hiring.
It is. And they're significantly increasing their tech spend, too, by nearly $100 million in 2025.
Wow. Big tech investment.
Yeah. And they specifically noted, quote, "We accelerated investments in people and technology late last year, and we are already seeing returns on those investments."
It's already seeing returns. That's fast.
It is. They gave a concrete example. Middle market banking teams they onboarded in Chicago and Southern California last November. They're already driving new client growth and bringing in business. So yeah, the investment seems to be paying off pretty quickly.
That's great to hear.
Yeah.
Okay, it's one thing to look at the numbers, the spreadsheets. But what are they hearing directly from their clients? What's the real-world sentiment out there beyond the balance sheet?
Yeah, that's always the interesting part, isn't it? They describe client sentiment generally as cautiously optimistic.
Cautiously optimistic.
Okay. So, while clients definitely acknowledge the broader macro concerns, geopolitical stuff, tariffs, trade issues, things outside their direct control.
Right, the headlines.
Exactly. Despite those headlines, they generally feel pretty good about their business.
That is a fascinating disconnect between the macro anxiety and the sort of micro reality on the ground.
It really is.
So what's the specific take on consumers versus commercial clients from KeyCorp's perspective?
Okay, for consumers, their view is pretty straightforward. The consumer is just fine.
Just fine. Okay.
And they back this up. They cited an average FICO score of 767 for their funding clients.
67 average FICO. That's excellent credit quality.
Very strong. Signals very low credit risk among their main customer base. They also highlighted the wealth effect.
Ah, right. People feeling wealthier because assets are up.
Exactly. They noted U.S. household wealth has increased by something like $100 trillion over the last 15 years.
$100 trillion. That's a staggering number.
It is. And they have a compelling internal stat, too. 1 million of their 2.5 million customers have between $500,000 and $2 million available to invest.
Wow. So a lot of potential wealth management business there, too.
Huge potential. Now, for commercial clients, the story is similar. Balance sheets are generally healthy. Liquidity is in good shape.
Okay.
And they feel companies are a lot more agile than they were before the pandemic. They learned a lot.
More resilient, perhaps?
Seems like it. They did a survey of 850 large commercial customers.
Yeah.
And 50% of them view the current environment as an opportunity for growth, not just a challenge to be managed.
Half of them see opportunity. That really supports that cautiously optimistic label.
It really does.
Right. That paints a picture of a pretty resilient client base overall. Are there any maybe expected tailwinds or headwinds they're keeping a close eye on? Things that could impact their outlook?
Yeah, they mention a couple of things. On the potential tailwind side, something they're tracking is the 100% bonus depreciation available for private companies this year.
Ah, the tax incentive for investment.
Exactly. It allows businesses to deduct the full cost of eligible assets right away instead of, spreading it out over years.
Right, which encourages spending now.
Potentially, yes. It's not actually included in their current guidance yet.
Okay.
But they suggested this could lead to a significant ramp up in CapEx, capital expenditures, business investment in the second half of the year.
Which would be great for commercial lending, obviously.
Absolutely. Now, on the watch list for potential headwinds, they mentioned leveraged companies, but noted that's only about 2-3% of their loan book.
It's a small slice.
Very small. Also watching Medicare-dependent businesses like some hospitals. And then from their special servicing business, the part that handles distress loans, they noted a little bit of a surge in lodging issues and continued vigilance needed in certain commercial real estate sectors, specifically office and also multifamily, particularly in the Sun Belt.
Okay, so targeted areas of concern within CRE, not necessarily broad problems.
It seems to be the message, yes. Vigilance, but targeted.
Got it. So with this strong performance overall, positive client sentiment, how are they actually revising their financial outlook for the rest of 2025? Does this confidence translate into higher projections?
It does. They positively revised several key guidance points, indicating, pretty strong confidence going forward.
Okay, like what?
Full-year net interest income growth, NII. They increased that guidance to 22% growth for the year.
Up from approximately 20% before.
Right. And they said that implies organic NII growth in the low teens, which is quite strong.
Okay, what else?
Their projected NII exit rate for Q4, so the annualized run rate at the end of the year, they bumped that up to 11% or better growth. And they expect Q4 net interest margin, NIM, to be approximately 2.75%.
275 NIM by year end.
Okay, loan growth also got an upgrade. Period end loans now expected to be up approximately 2% for the full year.
Which is previously guided as flat, right?
Exactly, up from flat. And within that, commercial loans are now expected to grow about 5%, up from their previous range of 2-4%.
So clear upward revisions on lending.
Yep. Fee growth guidance was reaffirmed at 5% or better, and they hinted at potential upside there from strong investment banking pipelines and expenses. They reaffirmed the 3-5% growth range, but said they plan to be around the midpoint, reflecting those continued investments in hiring and tech we talked about.
Right, investing for that future growth.
Yeah.
Okay, so this isn't just a bump up in the numbers. It sounds like it reflects how they plan to use their financial strength. What do they say about capital strategy? How are they planning to allocate that strength?
Good question. Their capital allocation strategy seems pretty clear. First, maintain that strong capital position. They're aiming for the high end of their target CET1 ratio, which is 9.5–10%.
Keep the buffers
So
correct.
the buffer strong. Use that strength to support client growth, obviously.
Yep.
Continue those investments in people and technology. They also mentioned they're looking to explore niche or tuck-in acquisitions.
Wow, smaller strategic deals, not huge mergers.
Exactly. And maintain their dividend. Importantly for shareholders, they also signaled plans for modest share repurchases starting in Q3.
Okay.
And then stepping up later in the fourth quarter.
Which signals confidence in their stock price and a desire to return capital.
Definitely. It's a positive signal to the market.
Okay. What about deposit competition and the overall balance sheet mix for the rest of the year? How are they thinking about balancing growth, cost, and competition there?
Yeah, they acknowledge there is some competitive pricing out there, particularly on the commercial deposit side. Things are still pretty rational on the consumer side, though, they think.
Yep.
They expect some seasonal growth in deposits in the second half of the year. And they're moving towards what they call a balanced approach between managing pricing, the beta, and managing the actual deposit balances.
So not just chasing deposits at any cost, but not letting them all walk away either.
Right, finding that balance. They also highlighted something interesting. Their ability to grow NII and NIM over time without needing a significantly larger balance sheet.
How do they do that?
Partly, it's due to the ongoing runoff of lower-yielding consumer mortgages. About $600–700 million a quarter are rolling off the books.
So shedding less profitable assets automatically frees up capital.
Exactly. Frees up capital that can be redeployed into higher-yielding opportunities, like that commercial loan growth we discussed. Improves the overall mix.
Yes. Smart balance sheet management.
Hmm.
Okay, and finally, as we think about those growth areas, you mentioned commercial loans driving things.
Mhm.
What specific types of C&I lending are fueling this? Where are they seeing the strongest demand?
They called out a few key areas. Renewables, where they see strong backlogs.
Okay, green energy finance.
Right. Affordable housing, also strong pipelines there.
Yeah.
Healthcare, which they see is undergoing a significant transformation, creating financing needs. And their public sector business remains strong. Plus, they just mentioned broad share gains again by their middle market bankers across different sectors.
So that investment in bankers is really paying dividends, it sounds like.
It really seems to be a core part of the strategy.
And what's on the horizon for consumer lending? You mentioned mortgages running off. Are they replacing that with anything?
Yes, they specifically noted their plan to lean into ELOCs, home equity lines of credit.
Tapping into that home equity.
Exactly. Given their client bases, strong demographics, high FICO scores, and all that home equity built up,
Right.
they see ELOTs as potentially a $2 or $3 billion opportunity for them.
Wow. That's a significant opportunity.
It is. And it's a smart pivot, right?
Yeah.
Capitalizing on their existing strong customer relationships and the wealth sitting in their homes.
Definitely makes sense. Well, that was a truly insightful deep dive into KeyCorp's recent performance.
Yeah.
It's really clear they're navigating this complex economic landscape pretty skillfully. Strategic investments, strong client focus.
Yeah, and that ability to turn challenges into opportunities seems key.
It does.
Their ability to deliver that consistent pre-provision net revenue growth, PPNR, manage those deposit costs so effectively, generate significant fee income, and do it all while actually improving credit quality. That really stands out.
It absolutely does. It shows a bank that, understands its strengths and knows how to play them in the current market.
Mm-hmm.
And here's where I think it gets really interesting thinking bigger picture. KeyCorp seems to have built a model where market dislocations, those moments of volatility or uncertainty that scare others,
Yeah.
they actually seem to present opportunities for KeyCorp to put more loans on their balance sheet, potentially capture share, and drive profitability.
That's a fascinating observation, and it raises, I think, an important question for you, the listener.
Mm-hmm.
If a financial institution like KeyCorp can proactively leverage market volatility for growth rather than just reacting defensively, how might that change your own perception of risk and opportunity when you look at dynamic economic times?
That's a great question to ponder. Well, thank you for joining us for this deep dive. We really hope this has given you a useful shortcut to being well-informed about the nuances of a major financial player like KeyCorp.
Yeah, and we encourage you to consider how these insights, the strategies, the client focus, the handling of complexity might apply to your own understanding of the financial sector and maybe even beyond.
Absolutely. Until next time, keep digging deeper.